This is the module 4, syndications. What is an accredited investor? So accredited investors are investors that are typically investing in these types of syndicated deals. These syndicated deals are also known as country club deals because back in the day, people would go to the country club. You had to be wealthy to go to the country club, and that was where these deals were shared amongst people. But nowadays, with the advent of technology, and who really goes to the country club anymore these days to play a 5-hour round of golf, it just takes too dang long. At least from our community, a lot of us are first generation multimillionaires. A lot of people who go to the country club are second, third, fourth, fifth generation wealthy people. And then a lot of the people are just not really interested in investing or growing their net worth. And that's probably why they always say 90% of wealth leaves families in 2 to 3 generations. That's why to get around the community that we've put together, we've got the family office Ohana Mastermind is super important. But first off, what is an accredited investor? Net worth $1 million or greater is supposed to be excluding your primary residence. I always thought that was a little bit silly. On the one hand, SEC is saying, hey, your house is not your asset and you shouldn't be paying down your mortgage and hiding your money in there because that's exactly where creditors and litigators know where to get it from. But also, they see it as to not have your money in your primary residence doesn't count as your net worth. But I also say you could just take a HELOC from it or get a loan from it, turn it liquid, and then turn it right back. The other way to qualify is income over $200,000 individually or $300,000 for a married couple. That said, a lot of this is not super critical, right? The accredited investor status, and we're going to be getting into 2 different deals out there, 506B and 506C. There's a couple ways that you go about doing this. You can self-certify or in a third-party certify situation. So a lot of times what people will do is they'll just get a letter from their CPA lawyer. We've got some really simple and easy form letters to give to your CPA lawyer so they can just sign on your behalf. And ultimately, it's up to them to certify you. I would say just try and get this letter because this is the qualification here. What it mainly is to not disqualify people at 999,999,999 net worth, or if your income is 199 a year, but it's mainly to keep in people who are just not qualified to invest in these types of deals, like people who have $250,000 of net worth, and if they lost $50,000 in a project, that they would just be financially devastated. That's really what these laws are put into place as their goal. And for that, I agree with that sentiment. Another way that people can get into accredited only deals is through a Series 7, Series 65, and various other securities tests. These tests aren't the hardest to get, but it's supposed to help out people who aren't quite accredited, but you can test your way to get in. But these are actually pretty rare to do. Most people are able to get their accredited investor letters. As soon as you start to come into a deal from a passive investor's perspective, meaning you don't have managing member authority, right? Sure, there's things that may come up where you may have a vote, but if you're in the sense of a passive investor, they've triggered securities laws, right? Securities laws are out there because if you think of like cryptocurrency, right now, cryptocurrency has been the Wild West. All kinds of crazy things happen there, and they just don't have a lot of these laws put in place. Whereas forming companies, raising capital, like the SEC, there's a lot of things that have happened in the past, and they've created a lot of laws to protect consumers and to minimize like the fraud out there. So what they've put forth is a couple of deal methods here. And so the first one is the 506B offering. Now this accepts up to 35 non-accredited investors and deals, but the deal cannot be mass marketed or what they call generally solicited. Now, again, you probably don't care about this. I'm teaching this more from the perspective of the general partner. So if the general partner wants to be able to bring in non-accredited investors, they have to go down this 506B route, but they cannot mass market the deal. So they can't put it on social media. They can't do any LinkedIn ads. They can't talk about it on their podcasts. They can't put it on their website. It cannot be generally solicited. As soon as they do that, the government says, once you've generally solicited a deal, now you can only do it as a 506C offering, which a deal can be mass marketed, like I said. But the problem there for the syndicator is that they can only accept accredited investors. As soon as people bring in passive investors, they've triggered securities law and they have to do one of these two. So some people are like, I brought in my four buddies and we took down this fourplex. In that arrangement, probably would make sense to make everybody managing members. But if one of those guys technically wasn't doing anything and they were completely silent, then that little group there has triggered securities law and they have to do a full-blown PPM. We usually pay like our attorney $15,000 to $30,000 to put this together. And then there's also blue sky filings that costs maybe another $5,000 on top of that. So this is expensive stuff. So a lot of operators, they just don't do these things, which makes things illegal. The SEC can rain down fire on the project and the general partnership there. Passive investors may say, well, that's not me. I didn't break the law. That was the general partner. But it can also bring the deal into scrutiny, right? If the general partnership becomes under fire, it can endanger the deal too. So I think even passive investors need to keep this in mind. Are they working with a syndicator who's blasting things on the internet? They better be doing a 506C offering that allows for generally soliciting. So to overlay my experience on this, when we first started, we would do 506B offerings, mainly because I had a soft heart for non-accredited investors, because it wasn't too long ago that I was a non-accredited investor. And non-accredited investors, you're limited to buying little single-family homes. But I would say after 2018, 2019, prices on properties and rental value ratios in single-family home buy and hold rental properties, or what I call turnkey buy, hope, and pray properties, where there's no value add. And there's value add in these syndicated deals. If there's no value add, there's not enough meat on the bone. And therefore, if you're a non-accredited investor, you're just left with not the best investment options. And how the heck do you get to accredited investor status? So that was what was in my mind back in the day. And it still is, right? I still want to try and help out people, especially those guys who make a good salary, but you're just still under that $500,000 stage. That's the hardest part of wealth building. And it just takes a while. I graduated in 2007 and it took me like almost 10 years to get to accredited investor status myself. So it's a grind. So in the beginning, I thought, why don't we give non-accredited investors access to our projects where there's value add, where they are in a group that they trust. Two things happened. The podcast got even more popular and we started to do things more on the internet, and just got to a point where our attorney was like, look, you guys are just way too out there. The investor group started to expand so big. And we started to do many deals. In 2020, we started to go over that $1 billion of assets owned threshold. We're probably going to keep growing from there. But it got to a point where we were not small fries anymore. And that we had a lot of syndicators, they cut corners a lot on their documents and just a lot of things in general when they're getting started, right? Because they have to be cost effective. And I think I always poke fun at like oil and gas operators, the cowboys out there. Literally, these are cowboys, right? I'm in Texas or Oklahoma. But a lot of these guys don't do any PPM securities documents. It's just bring in 100 people and on a JV document. And woof, that stresses me out for those operators. But that's just what those people will do. Not saying that they're not good deals, not good operators, but just from a security standpoint, not really following the law there. I don't want the SEC knocking on my door and then now I got to pay $250,000, $500,000 to fight them. I'd rather just do everything on the up and up. That said, we've moved more towards 506C offerings and we've lost our ability to accept accredited investors for the most part. If you're not a non-accredited investor watching this, stick with us, learn, and hopefully it'll make the transition from the first floor of the wealth elevator to the second floor of the wealth elevator a lot quicker. Don't do what I did and buy 11 rental properties. If I would have done it all over again, I probably would have bought maybe 3 or 4 and then moved up to syndications and private placements. The last thing I want to overlay on top of these two, now that we've set this up, 506B offerings. When you come into a deal, you obviously don't need to be accredited. But when you do your subscription documents, you are asked if you are accredited or not. And just a little bit of a trick, folks, if you've never done PPM documents, when you check the box that you're not accredited, the application asks you, hey, qualify yourself, because we don't want unsophisticated investors in these types of deals, right? So you have to justify yourself. And to avoid it, you just mark down that you're accredited. Of course, you're certifying yourself in that circumstance. So if people get my drift here, self-certify means you police yourself and you're certified that you are accredited based on your understanding of the definition. Of course, these definitions could always change very slightly. And sometimes they talk about increasing it, decreasing it, different things happen. I would say just check out the SEC website for the latest criteria at that current time. But I think everybody here, 95% of people on this call, are probably going to be looking to go to 506C offerings where you need a third party letter to invest in the deal. 506C offerings, if you think of it from my perspective, the syndicator, the SEC says, yeah, you guys can go out there and generally solicit, right? And part of that, when you generally solicit, it goes everywhere. And what the SEC is trying to avoid, and I totally agree with their angle here, is that they don't want like truck driver Tommy, who is broke and has $100,000 to his name because half of it was his new inheritance from his long-lost uncle, and he invests half of his total net worth. Number one, he doesn't have the financial stability. And number two, he probably doesn't have the financial aptitude to be able to make good investment decisions. But that's what the SEC is trying to avoid is these deals are genuinely solicited out there. That's why they put this restriction in place so that those unqualified or what the only way they're able to govern things is they say, oh, no, non-accredited investors investing in that deal. They say, hey, syndicators, hey, Lane, you can mass market this deal and you're probably going to have some people come up to your door that are unqualified because that's just how general solicitation works. But they need to be accredited and those people need to bring their third party letters. Like we cannot have them self-certify like the 506B offerings. So from our point of view is you need to bring us your third party accreditation letter. Now there's a couple of online methods out there, companies that have made it a nice little niche to certify you, where you submit some bank statements, some income statements, they review it, and they give you your letter. I think it usually costs like $50 or with inflation, it'll probably be over $100 at some point. It can take a little bit of time to do, especially if you're right on that line there. I would say that the easiest way and probably the cheapest way is just slip in this form letter that, again, you guys can email us at team@thewealthelevator.com. We can give you some easy form letters, some different formats to just get your CPA or lawyers, John Hancock, and then you're in. Now, there's some things that change from time to time, like how long does this letter last? Am I certified? In most cases, once you submit it, unless something changes, we as general partners don't really need to know. It lasts for quite a while. But that's where we really suggest people going to their CPA or lawyer because then you can get it renewed if you need to. Whereas like these other cool third-party sites, you got to keep paying them every single time. It's actually a good business for them. I wanted to identify a big thing when you guys look at deals. There's a bit of a slider here where on one end, you have institutional operators. So institutional operators, they've done billions of dollars of deals. These guys are experienced, they're reliable, they're large companies. However, you're not going to get the returns that you are from other deals. Maybe you're going to double your money in 10 years in these. The reason being is there's higher fees, more carry interest on the general partnership side. There's just more overhead, right? For some investors that are net worth $4 or $5 million greater in our family office group, we may put them into those types of projects. But On the opposite end of the spectrum, and I guess we're saying don't invest in these types, right? You have your fake it till you make it operators under $1 billion of assets under ownership. And these are the guys to stay away from. And these are the deals I would go into in 2015. And I jumped on landmines, blown off my arm, lost some money. But hey, it got me to where I'm at today. And I think that's the hard part about getting into this world, and what I try to help people get over these initial stages when they're investing with just garbage operators who are newbies, who just took a weekend course and now they think that they're a multifamily millionaire operator. Everybody's going to get started somehow. Some people focus on splits and fees. Some of these newer operators, yeah, they'll do 90-10 splits, 80-20 splits. They're just bad operators. They're just getting started. So not a good place to invest. But I think they can lure unsophisticated investors who key in on the wrong things. So there's a lot of like silly internet forums out there that talk about splits and fees all the time. The splits and fees are like how the deal payouts are structured. They focus in on that because I guess it's something tangible that people can understand. But what they fail to really focus in on is this thing a good freaking deal, right? Whether you get 90% of the profits on a crappy deal with a new inexperienced operator, I don't want to do that. But unfortunately, when you get into some of these like free internet forums out there, you start to get into this world because a lot of these people on the internet, they're not operators like myself. So they can't really speak to digging into the rent rolls, the profit and loss statements, what's the reversion cap rate and the underwriting, right? So they focus in on what's visible. Think of it, they focus in on the tip of the iceberg that's sticking up. Where I'll just say it, like I'm sophisticated enough to underwrite the deal, get a third party underwriter and underwrite it and dive beneath the surface and do true investigation on a particular deal. I look at the splits and fees very last. In fact, I don't really look at it because I look at the projected returns that my spreadsheet is giving me, and that takes into account that fee structure. What I'm looking at is what is this deal performing on the deal level? Again, if a deal sucks and an operator sucks, I don't care if I'm going to get 90% of it, right? 90% of zero is still zero. What I'm more concerned about is how fat is this deal? How good of a deal is this? And of course, who's the operator running it? And then with all things being equal, the splits and fees are secondary. But if I still hit my numbers that I'm looking for, whatever that's 70% return in 5 years or 100% return in 5 years, I don't care what the splits are. If the operator found a really good deal and takes half of all the returns, I don't care. That's good for the operator as far as I'm concerned. So getting back to the spectrum of more experienced institutional operators and fake it to make it newbies under $1 billion of assets, there's this world that we try to live in the middle, right? Experienced operators who've done dozens of deals and don't have egregious acquisition fees and splits. There are some operators out there, like some of the institutional operators out there, their promote may be 15% right off the top before the deal even gets started. Now, if the deal pencils and it works, then yeah, so be it. My only problem is if you're working with an operator under $1 billion of assets and they're newbie and taking those fees, that's where I have a problem with that. But a lot of this, like normal fee structures, normal acquisition fees, asset management fees are in the syndication class, which you guys should have in your members portal. That's a little bit more diving into the details. I think it's better to check that out in that format. But I just wanted to make this aware and how it overlays with the 506B and the 506C. Your institutional groups out there only want to work with accredited investors, right? Think about it this way, and this may be offensive to some. Nobody who is a good operator wants to deal with that accredited investor who's going to put $100,000 in and ask 1,000,001 questions. That's called a high friction investor. Nobody wants to work with that investor. Pretty much all non-accredited investors are high friction investors. If they lost $50,000 in a deal, they would probably be pretty decimated at that point. And this is also another reason why we've moved away from 506B deals and taking in non-accredited investors too. As much as I'm conflicted there, like I said, to me, like as far as like a company, I don't really want to take on that headache and that liability myself. So that's why we've been sticking more towards accredited investors these days. And you got to think about it, like you're probably thinking, oh, yeah, it's unfair, right? I'm a high friction investor. But in reality, it takes so much money to onboard people. As you guys see, like when we bring on you guys as investors, we do invest a lot of time, right? The staff talks to you guys, we get you set up. There is costs associated to that. So if you brought in a non-accredited investor and they only have enough money to invest in one or two deals, that's just not a good investment for us in reality. Like accredited investors should invest multiple times, right? We want long-term customers. And the only way that's going to happen is at least you're an accredited investor net worth $1 million or greater, right? Or make a good salary, $200,000 per person or above. Some people, they like to look for deals to diversify and they want to try and get in with a lower minimum. I would highly warn people, if any operator is willing to take less than $50,000, I would really scratch your head and ask, are they just desperate for money? We used to do it. When we first got it started, we were desperate for money. We were trying to bring in any investor and we'd just buy the worst 50 unit Class C properties when we're getting started. We were there at one time. And I can remember letting a handful of guys in at $25,000, $35,000. And half of the time, it was a huge mistake. They were the most needy investor, high friction investors. And that's just a lesson learned on my part. So sorry if that's you. People in the past have ruined it for you. And that's why we've moved to accredited only. But it can be a sort of a telltale on what kind of operator you're working with. I've gone as far as to say is if you're vetting invest sponsor groups, just throw out there, hey, do you guys take $25,000 minimum investments? If they do, ooh, be careful. And I guess the same can be said for like crowdfunding websites. Like some of those crowdfunding websites, you can put in like $1,000. I would just be careful because sometimes the crowdfunding websites, they're a broker dealer. They're not the sponsor, not the operator. They may be selling a different part of the capital stack. Sure, in the same deal, in the same asset, but different part of the capital stack. So the way I explain this is like people go to the outlet mall, right? Coach Outlet is one of the more popular ones out there. But in reality, there's different products that are made specifically for the cheapo Coach Outlet clientele. It's not the same exact purses that is sold in the real Coach place. So in a way, it's the same thing. The crowdfunding websites will be selling kind of Coach brand or in the same asset, but it may be a different part of the capital stack that it goes to a more retail investor, unsophisticated investor, which is more high fees typically, because it takes higher overhead to handle a higher number of investors, especially non-accredited high friction investors. So hopefully that gives you a little bit more insight into the industry. And then, yeah, we'll move on from this topic. So switching gears a little bit, syndications is part of the evolution of the wealth elevator. If you guys have checked out those pull-up pages with the chart, I have it on the second floor of the wealth elevator. In that chart, there's guidelines on like how much cash flow you have, how much net worth you have. Guys, they're just guidelines. It's not gospel. And there's big ranges. Like, for example, on the second floor, it says maybe $1,000 a month cash flow. But a lot of you guys come into this world cold. You don't have any single family homes or any investments, and you may not have any cash flow. But from a net worth perspective, you line up more to be a syndication investor. And I would say that's probably most of the people coming in these days. And this is why we do the onboarding calls, because there's really no way that you can just give out advice, or none of this is supposed to be financial planning anyway, right? This is just general infotainment here. That's why it's good to get into a conversation. I can give you your pros and cons, or just quite frankly tell you, hey man, your wealth elevator floor 2, just do syndications. Don't even do rentals or anything like that. Perfect example of that is if you're already making a couple 100,000 a year, even if you don't really have too much net worth built up, that would probably be the threshold to just jump into syndications and private placements and don't even do single family homes. A good use case for that is some of the dentists out there starting their practices or starting their career. They make a lot in terms of income, but they might have student loans too. So their net worth might be super low, but still it just makes more sense for them to go more passive into syndications. Additionally, your time is better spent progressing your career in that infancy stage than to mess around with single family homes. And also liability, right? Liability of owning those single family homes is way bigger than being a passive investor. But this is the evolution that we try to move people towards. I went through all these stages myself. It took me a while. And then people in our family office group, once you reach about 2.5 million, I think you start to see the light at the end of the tunnel. And I always define end game at around $4 to $5 million with a family and living in a higher price area like California.
If you're relatively younger in your 30s and 40s and you're already at that $3 million threshold, the irrevocable trust, get that thing tomorrow. If you're older and you've crested past that $5 million net worth, then get that too. I'm just throwing that out there, not giving any legal advice. But part of that has to do with this concept of core capital here. So I'll explain this. Core capital this is age on this axis. As you start to get older, you need less money. Right? A lot of us here have younger kids. You guys are in this stage where you probably need $4, $5, $6 million net worth to be able to put it in cruise control and not do anything. But as you get older, especially as kids leave, they're not a nuisance anymore. You can take them off the books. Probably only need maybe $2 or $3 million or even less, right? So that's this concept right here. So the idea is that's all you need. This dark blue corresponds to this dark blue, which is lifestyle spending. So lifestyle spending is like your basic needs. It's said in different ways to mean the same thing, right? This is how much money we need to survive and some beer money on the side. But at some point, we don't need it and it becomes more of this gray money right here, right? This is the legacy money. I think I might differ. I'm sure I'll change my mind, but I'm like, I only got one daughter and I'm like, even if I had two kids, I'd be like, hey, give them 1.5, 2 mil each. Any more, you're just gonna mess them up, right? I went to private school. I know what's up. So I would probably call this light gray, but I think half of you guys might call this dark core capital, right? It's needed. But at least we're talking about these concepts, right, in this way. So the idea is lock down your lifestyle spending first, your core capital first. And that's probably, again, let's just call it what it is, maybe 3 to 5 mil net worth. Once you have that, lock it up, and everything else, all the gray stuff that should go to this, gets put in your irrevocable and put up in the cloud and gone away out of your estate. But you're not going to do that investing in like traditional investments or not being your own business owner, right? Some of you guys own businesses. You have the ability to get there. But if you're just working for the man making $300,000 a year or less, ain't going to happen. You need to take more risk. But for most of people in our community, that's not the need. We don't need private jets. That's one blueprint I'm showing here. But what's nice, once you have your core capital set, everything else is off the table litigators too when you're doing this. That's what's so nice. It's like so freeing in a way that you're set. You're in cruise control, that whole concept. I changed the terms a little bit to align, but it solves the question of like, all right, yeah, how much do you need and what's the concept? And then it's also the concept of what's the real goal. People who have read the book, the Bill Perkins book, Die with Zero. Yeah, that's a recommended book. It starts to talk about this idea of maximizing your experiences. So, okay, so this is esoteric. So you have like money, right? We're all trying to get money, right? Money is very important when you don't have it. I think a lot of us, time is more valuable than money. In a strange way, you can change like money for time. Like I pay for the Whole Foods delivery thing. Whenever I get $40 worth of groceries, I have them deliver. I don't waste my time going to the grocery store, especially when you have young kids. I just pay. I don't care. Just pay. I'm paying for time. But there becomes a point where when you're older, you're sicker, and then you bring in health, right? You can't use money to pay for time at that point. But what is in the book, Die with Zero, the whole point is it's not necessarily time. Because you can have a lot of time and you can live an uneventful life, or experiences that is the thing. And this is where I argue you need freaking money to exchange for experiences. And at the end of the day, experiences to me is the point system. Now you might disagree with me, but experiences is what I think is a score at the end of the day. Throughout this, yeah, we're all here playing this game, trying to get passive cash flow. But the real game is exchanging your money for experiences while you're optimizing your finances. That's the optimization question. Maximize experiences, optimize financing. Well, we all know that you're getting older and you could die at any moment, which is why you need a trust. And your core capital goes less and less. So it makes sense to like, all right, when I get older, I just need to trade these suckers in, this money in for experiences. This is in super fine print here. Most of you are trying to go, and this is myself too, are trying to go for 99% confidence that you will have enough to last and understand the trade-off for limited time to achieve that. What that means is we're scarcity minded. We're like squirrels putting nuts away in the tree, and we're just running around. We have a shit ton of nuts in the tree, more than enough for a winter in Hawaii. And this is like the case for the people in FUM, right? I think more times than not, they're still like working their asses off, even though their net worth is 3 to 7 million net worth. And it just makes absolutely no sense. But that's the case. It makes sense, right? Because if you spent your whole life trying to save money, make money, you start to associate your sense of value on that. So that makes sense to me. But if you look at it like this diagram, it's stupid.
But it can also mean maybe your kids are growing up, or maybe you don't have kids. You live in Texas, a little bit cheaper area, and it's just you and your spouse. You very well could need only about $2 to $3 million net worth at that point. So it's a sliding scale. Like I said, everything I talk about is a range for the most part. But I think it's important to understand the why. The older you get, the less money net worth you need. So to use a morbid extreme example, say you're only going to live for a few hours or a day. All you really need is $5, $10 for a beer or two, right? Or essentially, you don't really need money. But the longer you live, and that's the hard thing, we don't know how long we are all going to live, the more and more money you need. Our goal here, or my goal for everybody, especially those in our family office group, is to optimize the amount of experiences we get by aggressively, as safely as possible, of course, save money with taxes, go into good deals, and implement infinite banking, this whole trifecta I keep talking about, to grow our net worth to a point where we can just go into cruise control. We can keep still doing the strategies, we can keep investing, but maybe we don't need to do it as aggressively. And then just go into cruise control and maybe even go into T-bills and chill, because you don't need the high returns at that point. And to spend time on things that you enjoy, family, friends, hobbies. The Wealth Elevator 3 is finding a passion. A lot of people like myself are very outcome oriented. Go to a job, you create a career. You start doing that for a decade or a few decades, or in your 40s or 50s. Somewhere down the line, you may start to associate your value as a person to your occupation, where my goal is to head you off before you get to that point so that you can have the necessary means to not go into that job. Now, a lot of you guys will continue working because you're incredibly talented. And that's all about life too, is contribution to the world in your highest and best form, which for a lot of folks is your day job or your business. If we can get people at least to that state of mind where they don't have to do it, they go in on their choice. That's my goal for everybody, and kind of what keeps driving me forward, helping people get to their point. It doesn't mean that you get to this point and you start to be a philanthropic person, right? And donating heavy amounts of money. I think that comes later, but unless money's not everything, but it gives you options. Now, this slide isn't meant to make fun of people. I used to be a newbie at one time. I never could grow a beard like some of these young guys do. I definitely didn't wear those skinny jeans that he's doing there either. I definitely had a lot of these new investor type of ideas in my head. And again, this is why it's critical to get around a community of other purely passive accredited investors. And quite frankly, guys in their 40s, 50s, and 60s. I would say that most of our investors are in their late 40s to early 50s. That's where most of our folks are at. And then, of course, we have guys in their 30s, people in their 60s, but I think that's the core age group within our community. They may be young, some gray hairs there, but a lot of people that I see have a lot of these ideas that on the right side here. What I'm trying to get you is to the left side, but that's just going to take time. Hopefully that I'm just bringing awareness to this. As they say, awareness is the first step. When people come in, they're like, they may be in a place of pain. They don't like their job. That said, maybe it's a different employer, a different boss, right? You don't need to work that hard. You can take a little pay cut and then they would be totally happy. The other thing that they look at when they look at their investments is they want cash flow, right? They want this short term feedback loop of success where they want to see money coming back into the bank account from the investment every month or every quarter. This is a little bit nearsighted. And again, I did the same thing myself. When I first started racing up to 11 rentals in 2015, I wanted the cash flow so I could quit my day job because I didn't like my job. That said, it was a little bit nearsighted because between cash flow and equity growth, you can't have both. It's very rare that you have deals that give you both, or you got to pick one or the other. A lot of developments, there's no cash flow, but there's high returns there. And on the other side of the spectrum, you could probably get 4% in life insurance. That's pretty much the most guaranteed thing. In the world of real estate and increasing the risk level, maybe you can get 8 to 10% cash flow yields on a quarterly basis or even monthly basis, but you're not going to get that high ROI bumper at the end. So it's one or the other. It's like a Chinese saying, you can't ride two horses. You have to have one or the other. We'll talk about later about where you pick deals. Is it more cash flow focus or is it equity growth focus? It's rare that you can have it with both. There might be a mix of the two where it's going to be a little bit less risk, a little bit less cash flow. There are some of those hybrid type of deals, but generally what I'm trying to say here is most people, when they get started, they're too much heavily focused on cash flow. And the only people that should be focusing on cash flow, if you're in retirement years, you're 60, 70 years plus, or you have a net worth of $3, $4 million at least. If not, to me, you got to get going. You got to get your net worth to $3, $4 million. You're not there yet. Might be more than your buddies, but it ain't not much in our world. And the people who have this are typically on their first couple dozen deals. This is when people come into the family office group, they get around other accredited investors and they get checked with this really quickly in the first 6 months. And I'm just trying to make people aware of it sooner. And especially because a lot of people, they don't have a network. They like to lone wolf it, which I think is very dangerous in terms of picking deals, but also you are misled with these strategies that can linger long term. Imagine 10 years from now, just saying, shoot, I don't know why I was looking for cash flow. I had a day job at that same time, but I missed out on a lot of returns because I went for the cash flow every quarter route versus the have the project bake in the oven and pull it out and grow my net worth a lot quicker in that timeline. But as you can see, that comes with experience. Experienced investors, number one, they don't have a job and they have other investments. And that's where this cash flow is coming from. They don't need that next deal to pay for expenses. They don't think in terms of months and quarters where the cash flow is coming from. They think of in terms of years, 5-year increments mainly, and decades, right? How is that those deals when they go full cycle, they're cashing out, and typically they're reinvesting the money anyway. They're never really using it to eat. This is also, you got your non-accredited investor on the right side and your more higher net worth accredited investor on the left side, or another term out there is qualified individual. I think the net worth threshold for that is $2.5 million at least. To me, the ideal thought is go into 4 deals a year for 5 years. That's 20 deals. That way you space it out. And I think at that point, that's not an incredibly huge amount of deals. I think a lot of people on my level, we've got 100 K1s coming back every single year. So you can imagine how many deals we're in. But it just takes time. And I think that's what I'm here to help people get over this hump because there's nobody really teaching this stuff. I think the reason why I've been so successful is like these kind of nuances come up and I make a slide and I talk about it and I memorialize it because the way I figure is if I had this aha moment and I would have a aha moment like this by talking to 3, 4 people all within a synergy of 2 to 4 weeks, I would jot it down. But I think most people it would just fly over the top of their head. They're definitely not memorializing it like how I do. And I think that's really been my secret sauce. Is like everything I learned from synergizing it through my community, and also by having this community allows me to get access to more and more people. Really, I think I would be hard pressed to find a bigger group of purely passive investors out there, larger than myself. That's such a tight knit community. But some other ideas that kind of come from this is, and this I would say, add this, consider this for your action plan moving forward. Passively investing is not a get rich quick scheme, but I think it's a get rich surely. Sure that there is market corrections that happen supposedly every 7 to 20 years. We just saw a big one in 2022 to 2023. That was a larger correction than in 2008. In fact, not a lot of people talk about it, but that happens. And that's why you have to diversify over a 4 to 7 year bridge. Because if you just happen to invest in the wrong year, which it will happen if you're doing it the right way, you have a few years or maybe in 5 years of good deals that will survive, or you've already taken your profits already. At that point, you can breathe a sigh of relief. I think that your portfolio is stable. But I guess what I would acknowledge is getting up to that point, right? Your first 4 or 5 years of investing, they're going to be somewhat exposed, but it is what it is, right? That's investing. There's always risk in investments. But I think the nice thing is like investing in real assets that provide utility in this world, as opposed to stocks. The stock world is like the traditional investment market. What dictates the price of stocks? And this is what really turned me off. When I just got out of college, I had 50 grand to play around with. I would do a lot of swing trades, buy something and then sell it maybe in the next few days or several weeks. But I really could never figure out what the heck correlated with the price going up and down. And this is just my opinion on stocks. I don't have any stocks personally. It doesn't make sense to me. But my big beef with stocks is that the price is not correlated with the performance of the asset or the company in terms of profits, etc. Some people argue it is, but in reality, it's tied with the expectations of the numbers of that company. And that's what I don't like. I don't know what the expectations are. And then I don't know what the reaction when those numbers come up to the Wall Street. And that's what it's very disempowering in my opinion. You can do a good job, company can do well, but if they don't hit expectations, you can get hammered. Where with real estate, a lot of this is in your control, right? You control what the net operating income is. Before you get into an asset, we run the due diligence and the numbers and see what this asset was working with. We get the full rent rolls. We see who people are moving in. We see who are the new people. We see who is leaving. Are they sticking around? And then we can physically verify, yeah, these renovations do yield higher rents through comparable sale analysis and just literally seeing it on the rent roll, on them being absorbed at higher rents. Or with a development, I think it's actually even simpler to verify things. Build a property for $150,000 a unit and you sell it for $250,000 a unit based on comparable sales that have happened around the area. Very clear path to profitability. You buy for this, you sell it for this is your profit. That's what you take home. And to me, that excites me because I like it's big numbers, but also it's very clear. No different than maybe this is why I didn't like my job. I had bad management, right? I didn't know what the KPIs I needed to hit to get a good performance review, right? I think we've all gone through that experience, but that's my frustration with traditional investments versus alternative investments. And another point on the first point here are real assets that provide utility in the world. If you're somebody who likes to invest in things like housing, self-storage, mobile home parks, and then as we get into private equity, manufacturing, like a lot of these products that it creates provides real direct utility to humans, Americans. And you're like, I see the profit and loss statement. I see how you're making money with this. You take the raw materials, cost of goods and services, and this is the profit. Not everybody has the ability to sit on a webinar like this, network with some people, and then I think the biggest thing is get off the beaten path. I think once you acclimate yourself and you build your network and you get more comfortable and you get accustomed to a trusted community like ours, you're going to realize that this ecosystem is rather small. It gets a lot fun. That's a I enjoy about this. A lot of cool people, a lot of eclectic people join our group, and you can get very comfortable. That said, a lot of education, getting through the threshold. That's where I try and help people get through that threshold and get started in this world. But it is daunting for sure, because it is very different than the traditional investment path. But this is the idea. And this is any investment, whether it's a single family home or syndication. The biggest mistake I see investors make, especially single family home investors that only own a property or two, and you may have a wealthier auntie or uncle or friend that has a paid off rental that they own. They have violated this cardinal sin where, sure, when you get into an investment, you look at things from a return on initial investment level. And typically it's 10 to 20, 30% ROI. I have a video on this kind of going through the numbers at thewealthelevator.com/returns. But for just discussion, when you first go into deal, your return on investment or return on equity is very high. And once you get into a deal, you need to switch from evaluating things from initial investment to more return on equity. So what is that? Return on equity is a little bit similar calculation to return on investment. Return on investment is how much profit you made from your investment divided by your initial investment. So if you spent $50,000 to invest and you got $5,000 that first year, 5,000 divided by 50,000, that's 10%. But as time goes along, the property goes up in value typically, either from forced appreciation or market appreciation. But certainly by you paying down the mortgage, you're getting more equity build up there too. So you also have to count that. So over the years, that denominator of that calculation, which is the return on equity calculation, goes down. So that's where this phenomenon where you're seeing this line go down. So it's a tricky thing. I would say, to give you more of an extreme example, a lot of people in Hawaii, they have paid off $1 million houses, which I don't think is the thing to do. But again, most people out there should pay off their houses, right? Most people. You, if you're listening to this webinar, are a little bit more financially adept than the average bear out there. And you guys are playing a little bit more offense, like how we're talking about here. But that person who has the paid off house, $1 million, if they put a renter in there, maybe they rent it out for $5,000 per month, $1 million house, they've got to pay expenses on it. So really maybe they profit 30 grand per year divided by $1 million of how much equity they have is 3%. And most people would say, why the hell would you want to do that? Just put your money in like something like life insurance where it's zero risk, zero liability, and just a cleaner asset. But this is obviously what a lot of people do because they just aren't aware of this whole concept. Now, sure, when they didn't have as much equity in it, the return on equity was much higher. And at the end, the extreme point I gave, your return is almost nothing. So to sell or re-leverage and get it to the next deal, that's up to you. In my opinion, I think beating 10, 12%, you can probably do that pretty easily in the alternative investment world. The idea is ride that deal down to this point and then re-leverage it. If you have a single family home that's good amount paid off, sell that sucker and get 2 or 3, and then ride those deals and do the same thing, get 9 deals. But this is where the syndicated deals do this for you. And the nice thing is none of the debt gets put in your name as a passive investor. And if things were to go south, you're not the person holding that lien. You're not a loan guarantor on that. The general partners are typically the loan guarantors. The syndicated arrangement, some people complain about these deals are so short and then I get my money back with the great returns, but then I got to go find another deal. Hey, that's just how it is. That's what the goal for most syndication is, to get the highest amount of ROI in the shortest amount of time, kick you out. And then unfortunately, you got to go find another deal. But once you're in this world, you're going to find deal flow pretty easily. That's what the family office Ohana Mastermind is all about. You're going to get thrown right into the deal flow with a bunch of other people there too. But I'll just point that out because I think I heard it on some investors say, I like working with these guys. They exited out us in 3 years instead of 5. I wish they would have just kept us in there. That's a little silly because we've done this. We've done a development and you make the most money when you're building the asset and then leasing it up the first few years. After that, sure, everybody likes cash flow, but in reality, your return on equity isn't very much at that point, and which is why we turn them and burn them and sell them. Now, of course, that creates a capital gains situation, and we've got a full e-course on I think, 8 ways you can mitigate that capital gain. Solution there that most of us will do is the lazy 1031 exchange, where you're investing in many deals outside of this one in particular, and you're using those passive losses to offset that deal, and then you get more passive losses to create the good vicious cycle in a way, or that what we call the golden hamster wheel, and you keep delaying the capital gains forever or to your death. But again, check out that tax section. If you guys are logged into your members portal, you should have access to that. That I think it's a 1 to 2 hour series of 8 ways you can mitigate those capital gains. But other than that, that's really the only downside. Really, what we're trying to do here is maximize the amount of returns and not get you in the situation where you're in the buy hold stage, not really making too much money. But some people call this phenomenon like C curves. I invested in coffee farms. I remember sitting there, it was really hot. I don't like to get hot very much, but it was like in a tropical rainforest. But what they'll do is they'll grow the coffee plant. I think it takes 4 to 5 years for it really to start to have coffee beans, but they'll harvest it. And then a year or two will go by, and then the stump will continue to grow. What they'll do is they'll cut off the coffee arms to re-stimulate the coffee growth. The coffee beans are obviously the ROI, the returns. And they'll do this for several seasons. The stump of the coffee plant, it'll be under an inch thick, but it gets pretty beefy. It can be like 5 inches. And the problem there is like the more and more fertilizer you have to invest in that plant to grow an equal amount of coffee, maybe a little bit more. But what they do is they continually prune the plant. But at some point, that stump is so big and it's just drawing, you need to feed it too much nutrients to get the same amount or just slightly more coffee beans. That's better just to dig that thing up and burn the plant and start new. That idea of pruning the plant, trimming off the branches that gave you the coffee, and then having the plant regenerate in a way, it's very similar to this phenomenon. And if you're somebody with a handful of rental properties who have under 50% loan to value and paying off your debt, you're probably like, oh, shoot, I've been doing it the wrong way for so long. That's just one of many ways. Like our idea is to source the best practices. Of course, with debt, you play around with a little bit more risk, but this is where everybody's on different parts of the journey. If your net worth is already $4 million, then yeah, sure, pay down your properties or pay off your mortgages. But at that point, I guess what we're saying is get out of rental property ownership altogether. Go to syndications where you're not the debt holder. You're not on the front line of the liability at that point. And I think that makes sense for anybody over $1 million net worth. You don't want to own dirty rental properties, high liability rental properties. You want to get into syndications. And that's the nice thing about syndications. It does this pruning for you automatically. The people ask like, all right, it all sounds cool, but maybe give me some like working models. And this is where I'm always a little hesitant because I'm like, I'm not a certified financial planner, certified to sell you marketable securities and get paid off of that, whether it's a good investment or not. Obviously, we put together these deals because I'm the sponsor on it. I got carried interest that the asset succeeds. And also we got our own skin and reputation on the line. I think that's what sets us apart from most people out there, certainly the certified financial planner who's just selling you stuff and he just splits and leaves after he makes the sale. So again, I'm just prefacing that this is just infotainment. This is not financial advice. If you were looking to maybe just get started with a $500,000, which I think most people do in their first years of doing this, especially if you've been traditional investments your whole life up to this point. I'm big on just, hey, baby steps moving forward. Of course, if you're going to be investing more than $250,000, I would highly suggest joining the family office on a mastermind because there you're going to get the network, right? If you don't join that group, you're on your own. You're a lone wolf. And it is difficult being a lone wolf because that's how I did it in 2015 when I went from 11 rentals and transitioned to a syndication portfolio. I went to a lot of so-called conferences, met a lot of people, and experienced in single family homes and real estate. But I would say that the first 15 deals I went into, a few of them were with either shysters or just fake it to make it operators. And I didn't do well in those deals. So my failure rate was 1 out of 5. So if you're thinking about investing $250,000, 50 grand of that probably is going to be a little bit up in the air. I think that's more than pays for the food membership. And then you get the relationships tacked on top of that. Like it's there for you. But if you want to lone wolf on it and just, I think the other mistake is like people get into these deals so slowly and they're not diversified one bit. They're in like less than 5, 6 deals. That's not diversification. So you got to get into it. And that kind of puts people in a difficult position, right? They've been doing things so long for one way. And what I'm on the other side is this totally changing your portfolio. But whether that means 50% of your net worth into alternative investments or 80% of your portfolio in alternative investments, your level of jumping into this stuff is up to you. But you're not going to get there with 10, 20% of your net worth. That's just going to get proof of concept, but that's not going to change anything financially for you. Just speaking from my own experience, in my 20s, what got me to where I'm at today is I went very heavy, 80% plus into alternative investments for 5 to 10 years at least is going to make a noticeable difference. But if you're starting out, what I would say, just dabble, right? Try and get diversification as much as you can. Try and spread out your money. That said, you got to think about $50,000 got to be your minimal investment that you're going to have to put in your head. The reason being, most syndicators who are decent that have $1 billion of assets, again, key mark that threshold. A lot of these guys, they have these silly websites where they're saying, "Oh, we've done $300 million of deals." Like $300 million isn't anything. That's nothing. That's unless you're over $1 billion, you're still in newbie status. And those are a lot of people that I invested in my first 15 deals. Like I said, you're just working with these fake it till you make it operators who anybody can put together a website. And then, especially if you don't have a network, I know what you guys do. You guys just go on podcast land and see who's talking about syndications and you invest with them. That's the absolute worst way you can be an investor, guys. That's the worst way. Don't do that. You're going to find some of the worst operators getting started. Today, what we do to find operators to work with, whether we operate it ourselves, is off our network of general partners, right? Unfortunately, you're not going to have access to that unless you kind of work with us. But this is a stair-stepping game, right? Like I said, your network is always going to be constantly improving over time, and it's just going to take time. You just have to have patience. My hope is to help shield you from just garbage deals with garbage operators. And these are the guys typically who troll the real estate investing club. If you want to know what I'm talking about, just go to the local real estate club and you'll see some of the slime balls that are out there and some of the garbage deals that are being syndicated. And I think you can also just type in real estate syndicator school and you can find some of the newbie operators and what they look at. And what you'll find is it's very hard to determine who are the fake it to make it and who are the legit operators out there. What we try to do is we try to find people or operators that are more on the introverted side and don't do any marketing. In fact, they're horrible at marketing, which typically means that they're good operators. A lot of people are really good at prancing around on the internet. I myself have gotten better at this. I know the tricks of the trade nowadays, and I know where to spot it. And I see it as a big turnoff. Again, I like to find introverted operators that don't do marketing very well, that are really good at operating, because the good operators are the good people that you want to be in their deals. There's funds out there that are diversified, especially getting started. I think it's a great way to diversify. The biggest food group that people will start off with is apartments because you've lived in apartments or you've rented a house, maybe in college, and you know what that dynamic is. There's other food groups out there in the real estate world, such as like mobile home park, self-storage. I'm not a huge fan of self-storage because it's just the nice thing about Class B, Class C multifamily is it doesn't directly compete with new inventory being built or everything in self-storage needs to be Class A. So if you're unfortunate enough to be in a project where somebody just builds a Class A self-storage facility next to you, you're screwed there because they're competing directly with you and it just throws off your comps. But diversify, learn. No way of learning other than investing and putting your own skin in the game. And also, sure, we have the syndication e-course for you guys to take part in that should be accessible in your guys' members portal. 10 hours of content for passive investors. And I would say once you go through that, have the confidence that you know more than most accredited investors out there. But really, all that is to set you up so you're aware of these concepts. And at that point, if you did come to one of our events, I'd be able to sit you down at a group of 5 other accredited investors and you would be able to hang in the conversation. And you're not talking about silly things like what's a preferred rate of return. And you're understanding what split structures are. You're understanding a lot of these concepts. And you guys are smart people. It's just like a lot of the concepts just aren't talked about in normal American vernacular. So that's what the e-course is for. But the real magic happens is when you start to join a community and start to build one-on-one interactions with people out there also doing this stuff. And that was where I was back in 2015. Prior to that, I don't want to pay for anything. I don't like people. I'm just gonna do it all by myself, right? Got his e-course. I'm gonna just do that. Look, I had the same attitude from 2009 to 2000 or 2015. I played that game. I just thought I was all cool, too cool for school. I'm just going to be a lone wolf. But in 2015, a magical thing happened. I started to, by chance, interact with accredited investors. And this is where you're seeing a lot of this curriculum from deal vetting to infinite banking, accredited investor banking to tax strategies. These best practices is what I crowdsourced from a lot of these people in 2015 when I finally got out of my shell. People who know me as a pretty big introvert. Obviously, it doesn't seem like that because I'm super passionate about this stuff and it's fun. But I really like to interact with talking finances and money like this. Most people think that we're weird because we talk so openly about our money to seemingly strangers. But you come to the retreat after a few days, you're lifelong friends for life. It's a huge bonding experience. And that's what I wanted to create at our annual retreats. But you guys are allowed to come once and test drive. You got to pay, of course. Things free. But to come again and be a part of the community long term, you have to join the family office Ahana Mastermind. What I realize is I'm really bad at selling that group. And there's no better way to seeing if it's a good cultural fit for you to meet the other participants and get a vibe of our community. So that's why we do events from time to time a year, open houses, but for the most part, we are a closed group organization. One of the big reasons is in the past, we are well known out there in the general partner newbie syndicator world, and they would love to get in the walls of the wealth elevator because we are probably one of the biggest purely passive investor groups out there, which is unfortunately like why I have to put the guards up in some respect, which is why everybody who comes to our events are vetted. And that's what part of the reason why I have the onboarding calls to just get the vibe of people. Are they right fit? Ultimately, if I bring somebody in, even as a guest to a one-time event, it reflects badly as me, the host. I want everybody to have a great time. I want the right people who are open-minded, who aren't weirdos, to be honest. I want everybody to have a good experience and to create that culture and that safe environment where people can talk about their finances in a confidential place with growth-minded people too. Amazing things happen, right? And I think it creates an environment where, you don't meet very many new lifelong friends after you leave college or once you're in your 30s and 40s. But that was the goal of this group, was to create a cornucopia of people who are first generation multimillionaires, good value system, works hard for their money, but wants to invest, have the patience, and then reap the rewards all together. And you climb the ladder or you send the wealth elevator floors together. Different samples of different ways. These are just ways to think about how you would do this. Of course, I'm trying not to get into like nitty gritty because then I get myself into trouble, right? Because people are like, you gave financial advice. None of this is financial advice, folks. Just 2 data points here. On the left side, you have maybe somebody who's a little bit more cash flow focused. Again, I would say this is really for those people who have a net worth of $3 to $4 million or greater already, or you're already in your 60s and 70s where you need cash flow. If you're relatively younger, in your 50s or younger, or you're just growing your net worth, still in the $1, $2 million range, you got to get after it. You got to go for equity growth and don't get suckered in with this idea of monthly cash flow, quarterly cash flow. But I will validate, I guess this is very common. People are like, I won't say this, but this better work. If not, my wife will kill me because I'm doing something out of the ordinary. A lot of you guys don't even tell your spouses what the heck you're doing. You come out to the live events, you'll see where everybody's head is at with this stuff. I know what you guys are thinking. And with that, you'll be guided more towards cash flow. So at least when your wife asks you, hey, what'd you do with that $100,000? It's been a year or two. You can say, yeah, I've been getting started. Yeah, the cash flow started 6 months after we got into the deal. Here's the bank statements. Get off my back. At least you can celebrate in the success, right? I know what you guys are thinking. I think I have an idea what I think is best for people, but I think the biggest thing is, like I said, baby steps. Whether you go into cash flow deals first or later, as long as you get into alternative investments and then get you a rolling start, and then you meet other people in the community, you start to expand your ecosystem. 10 years, 20 years, I think it won't make a difference where you are. The 5-10% rule that I have, I'm careful when I say rules, right? Because people think of them as absolutes. Nothing is absolute in this world. The 5 to 10% rule is you never want to have more than 5 to 10% of your net worth into any one project. So if your net worth is 2 million, probably don't want to be putting $200,000 into one particular asset. Now, diversified funds are different, right? They're diversified. So feel free to put a little bit more and bend that rule. Number two, your startup phase with 10 to 20% net worth in the first 2 to 5 years. This is what most people will do. They'll take 10 to 20% of net worth and then spread it around. So if your net worth was $2 million, $200,000, $400,000 of that, you'll put that into 4 or 5 deals or so. I would say try and get to this 20 deal portfolio as soon as you can, because then I think you can breathe a sigh of relief at that point. That if you did that, you're in 20 deals, and more importantly, you're spread over 5 years. Even if there was a correction in year 4, you're fine. If you think about it metaphorically, it's a bridge. A bridge can bridge you over, even if you got some down years in the middle there. But this on the right side, like with the development deals, you have a little bit quicker full cycle because it takes a year to develop, another year to lease up, and maybe you could even sold before that. But that's where the magic of this syndication works. Like it's going to be slow for the first few years. The value add is going on behind the scenes. Your general partners are hard at work, and then your deal goes full cycle, and then you reinvest that money. And then now you can see you're off and rolling. Depicted a little bit different way. You can go one way in terms of equity focus versus cash flow focus. And your path is somewhere in the middle. I think you got to get off thinking your first deal. Think of it more, okay, what are my first 12 deals? How's it going to look? Right? Because it's all going to be all in the middle here. And I think this makes a lot of people uncomfortable because you guys are used to these target index funds or these asset allocation mixes where you go 10% international, 30% large cap, 20% medium cap. Throw all that out the window. We are in the alternative investing world. There is no normal here. Some people have just 10% of their net worth in alternatives, and that may be all cash flow stuff. Some people have 70 to 100% of their net worth in these deals, and it's all equity growth, right? It's all over the place. So I think that's why you have to dig down into people's individual stories and investment values, and you'll start to build your investment criteria and values over the long term. But unless you get started with your first half a dozen deals, you got to learn by doing, and then you got to mix it up with the right people.